Hey there! Have you ever found yourself dreaming about investing in the stock market, but then you remember your piggy bank is running on empty? Well, guess what? Even if you don't have a ton of cash stashed away, you can still get started with investing. Today, we're going to walk through some strategies that can help you start your investing journey with little money. Now, let's be clear from the get-go. Investing is not a quick fix for financial issues, nor is it a guaranteed path to immense wealth. But it's a tool that many people find useful in growing their savings over time. So, whether you've got $50 or $500 to spare, I'll be sharing some simple steps to get you started. Remember, this is for education only, not financial advice. Do your own research and consider consulting a professional when needed. So, whether you've got $50 or $500 to spare, I'll be sharing some simple steps to get you started. Remember, this is for education only, not financial advice. Do your own research and consider consulting a professional when needed. First things first, why should you even bother investing? Well, sitting money in a traditional savings account might feel safe, but with low interest rates, your money isn't growing much. Investing, on the other hand, offers the potential for higher returns. Over time, these returns can compound, meaning your money is making more money. But remember, with greater potential rewards come greater potential risks. It's important to understand these before diving in. You might be thinking, I need thousands of dollars to start investing, right? Not necessarily. There are many investing platforms that allow you to start with as little as $5. Sure, you're not going to become a millionaire overnight with that, but remember, investing is about long-term growth. And the earlier you start, the longer your money has to grow. Sure, you're not going to become a millionaire overnight with that, but remember, investing is about long-term growth. And the earlier you start, the longer your money has to grow. With so many investment platforms out there, how do you choose the right one for you? Look for a platform that suits your financial situation and investing goals. Some platforms let you invest in fractional shares, meaning you can buy a small piece of a company's stock for a fraction of the price. This can be a great option if you're starting with a smaller amount of money. Just remember to check for any fees that might eat into your returns. Here's a key piece of advice. Don't put all your eggs in one basket. This is called diversifying your investments. By spreading your investments across a variety of assets, you can potentially reduce your risk. For example, if one investment isn't performing well, you might still have others that are. And even if you're starting small, you can still diversify by investing in a variety of different companies or sectors. Starting with little money doesn't mean staying with little money. One of the best ways to grow your investments over time is to regularly contribute to them. Even if it's just $5 a week, those small amounts can add up over time, especially if your investments are earning a return. As a beginner, it can be overwhelming to navigate the various types of investments available. To take the first step forward, it's crucial to understand the basic categories of investments, often referred to as asset classes. Stocks or equities represent shares in a company. When you buy a company's stock, you become a partial owner in that company. Stocks have the potential for high returns, but they can also be volatile and carry a higher risk. Take the example of Apple Inc. If you had invested in Apple in the early 2000s, your investment would be worth many times more today. However, the stock market can also be unpredictable, and prices can drop. Bonds, on the other hand, are relatively safer. When you buy a bond, you're essentially lending money to the issuer, which could be a corporation or the government. In return, the issuer promises to pay you back the principal along with interest after a certain period. For instance, if you invest in a 5-year bond with a 3% interest rate, you'll receive your initial investment back after 5 years, plus the accumulated interest. Mutual funds are another investment option. They pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other assets. They're managed by professional fund managers and are a good option for those who don't have the time or expertise to manage their own investments. For example, a Vanguard S&P 500 mutual fund invests in the 500 largest U.S. companies, providing a diverse exposure to the U.S. equity market. Exchange-traded funds, ETFs, are similar to mutual funds in that they offer diversification. However, they trade on an exchange like individual stocks, which makes them more accessible. For instance, an ETF that tracks the technology sector would include stocks from tech companies, allowing you to invest in the entire sector rather than picking individual stocks. Real estate is another popular investment choice. This could mean buying a property to rent out or flipping houses for a profit. Real estate investment trusts, REITs, offer a way to invest in real estate without the need to own, operate, or finance properties. Lastly, many people choose to invest in commodities like gold, silver, or oil. These investments can act as a hedge against inflation, as their value often rises when the cost of living increases. One of the key principles of investing is diversification, which involves spreading your investments across different types of assets to reduce risk. Think of it as not putting all your eggs in one basket. If one of your investments performs poorly, others might perform well and offset the loss. For example, if you invest solely in tech stocks and the tech industry takes a hit, your entire portfolio could suffer. But if you have investments in other sectors or asset classes like healthcare stocks or bonds, the impact on your overall portfolio would be less. Diversification can be achieved in many ways. You could diversify across asset classes, investing in a mix of stocks, bonds, and real estate. You could also diversify within an asset class. For instance, within stocks, you could invest in different sectors like technology, finance, or healthcare. International diversification is another strategy, where you invest in foreign markets to spread the risk. Remember, while diversification can help lower risk and smooth out potential returns, it doesn't guarantee profits or protect against all losses. It's important to align your investment choices with your financial goals, risk tolerance, and investment timeline. Consistent investing, also known as dollar cost averaging, involves investing a fixed amount of money at regular intervals, regardless of the market conditions. This strategy can be particularly effective for those starting with little money. For example, if you decide to invest $50 every month in a mutual fund, some months you'll buy more shares when prices are low, and some months you'll buy fewer shares when prices are high. Over time, this can potentially lower the average cost per share of your investment. Consistent investing can offer several benefits. It takes the emotion out of investing, as you're not trying to time the market or make investment decisions based on short-term market fluctuations. It also allows your investment to grow over time through the power of compounding, which can be particularly beneficial for long-term goals like retirement. However, like all investment strategies, dollar cost averaging has its risks, and it's important to consider them in the context of your overall financial plan. Regular, disciplined investing doesn't eliminate the need to monitor your investments and adjust your strategy as needed. Remember, investing, even with little money, is a journey that requires patience, discipline, and a well-thought-out plan. As you gain experience and your financial situation evolves, your investment strategy will likely need to evolve as well. Beyond stocks, bonds, mutual funds, and ETFs, there are other investment options that you can explore, even if you're starting with a relatively small amount of money. These include real estate, cryptocurrency, and peer-to-peer lending. Real estate is a tangible asset that tends to appreciate over time, which makes it a good investment option. However, buying a property requires substantial capital. Fortunately, there are real estate investment trusts, REITs, which allow you to invest in real estate without having to physically own a property. These trusts pool money from several investors to buy properties, and the profit from these properties is then distributed as dividends to the investors. For instance, a Vanguard real estate ETF allows investors to gain exposure to the real estate market through a diversified portfolio of REITs. Cryptocurrency is another investment option that has gained significant attention in recent years. Cryptocurrencies like Bitcoin, Ethereum, and Ripple are digital or virtual currencies that use cryptography for security. The value of these currencies can be highly volatile, offering the potential for high returns but also posing significant risks. It's important to understand these risks before investing, and to only invest money that you can afford to lose. For instance, if you had invested $100 in Bitcoin in 2010, it would be worth millions today. However, the value of Bitcoin has also experienced significant drops, so the risk is high. Peer-to-peer lending is an alternative investment option that involves lending money to individuals or small businesses through online platforms, bypassing traditional financial institutions. Investors can earn interest rates higher than those offered by banks, but the risk is also higher as the loans are unsecured. Platforms like Lending Club and Prosper allow you to start investing with as little as $25, providing a way to diversify your investment portfolio and potentially earn higher returns. Each of these investment options offers different benefits and risks. Real estate can provide a steady income and potential appreciation, but it can also be impacted by market factors like interest rates and the economy. Cryptocurrency offers the potential for high returns, but it's also highly volatile and can be influenced by factors like regulatory changes and technological advancements. Peer-to-peer lending can provide higher returns than traditional savings accounts, but it also comes with the risk of borrowers defaulting on their loans. As with any investment, it's important to do your research and understand what you're investing in. Diversification, or spreading your investments across different types of assets, can also help to mitigate risk. Remember, the goal of investing is not just to make money, but also to preserve your capital and earn a return that outpaces inflation. Whether you're investing in stocks, bonds, mutual funds, ETFs, real estate, cryptocurrency, or peer-to-peer lending, keep these principles in mind. So, there you have it. Investing isn't just for the super rich. With careful planning and a little bit of knowledge, you can get started with whatever amount you have. Remember, the goal of investing is not to get rich quick, but to grow your wealth over time. And as always, this is for education only, not financial advice. Always do your own research and consider consulting a professional. Now, are you ready to start your investing journey? Hit that subscribe button to stay updated with more educational content like this. Until next time, keep learning, keep growing, and aim for the financial stars.